This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, we're now going to look at absorption costing and the calculation of absorption profit. And to explain what I mean and how we deal with this and where the problem lies, can you look straight at example 1? XPLC produces one product, desks. There's then data about the budgeted costs. It's budgeted to require 4 kilos of wood, 4 hours of labour and so on. We'll look at the detail in a moment. The selling price is fixed at $35 a unit. It then tells us at the end, during the first 2 months, XPLC expects the following levels of activity. January, produce 11,000, sell 9. February, 9,500 units, sell 11. Now, and we're required to produce a cost card using absorption costing and to set out profit statements for these 2 months. Well, let's do it and start to look at the detail. And first of all, part A, the cost cards. We've already dealt with this in earlier chapters. But let's set it up. What's the cost, the budgeted cost per unit? Each desk is budgeted to require 4 kilos of wood, so materials. 4 kilos of wood, $3 a kilo. So the materials, $12 a unit. In addition, 4 hours of labour. And labour's paid, what, $2 an hour? $8 a unit. In addition, variable overheads. $5 a unit. There are also fixed overheads, and you remember if we're using with absorption costing, we need to absorb these fixed overheads. And here they only make one product, and so we can go straight into our absorption rate. That it says they're budgeted at 20,000 units a month. On average, we're producing 10,000 units a month. And so we absorb $2 a unit. There's only one product. Remember, if there were several products, we'd probably work out a rate per hour and then charge it. But with one product, no problem. $2 a unit. So that gives us a full cost per unit of $27. And there is the full cost or the absorption cost. Now, although that is in fact the end of the of part A, the cost card, I'll do one extra little bit in that it tells us what the selling price is. The selling price, $35 a unit, and therefore surely the budgeted profit, or we often call it the standard profit, well, if we're selling at 35 and the cost is 27, that gives us a profit of $8 per unit. So there's the profit we're expecting. Part B wants profit statements for the months of January and February. Well, first of all, January. It says in January, we're going to produce 11,000 units and we're going to sell 9,000 units. Now, a couple of things there. If we're producing more than we sell, we expect to end up with a closing inventory of 2,000 units. And also, it did say earlier, our average production is 10,000 units a month. Well, fine, if on average we're making 10,000 units, we absorb the fixed overheads at $2 a unit, but it is only average. Some months, as in January, we might produce more. Some months we might produce less. You know, clearly, it would be extraordinary if we produced exactly 10,000 units every month. Before we do a profit statement, how much profit do we expect to make? The expected profit, well, this is January. The sales are 9,000 units. We just worked out the profit per unit. We're budgeting on $8. And so we expect a profit of 72,000. Or do we? There is a problem. It's not 72,000, and let me explain why by setting up a full statement. You won't be expected to set up a full statement in the exam. I'll give you the rule we're going to apply afterwards. But it is important that you understand where the rule's coming from, which is why I'm going to set up this full statement. Let's do a full profit statement. Again, January. The sales revenue, what is it? We're selling 9,000 units. The selling price earlier on is 35 a unit. And so 9,000 at 35 is 315,000. To get the profit, we need to subtract the cost of what we've sold. And to get the cost of sales, I'll work out the cost of the production. And remember, we produce 11,000 units. And then I'll subtract the cost of those we've got left, the units in inventory. So first of all, what's the cost of producing 11,000? The materials, look at the cost card, $12 a unit. 11,000 at 12, 132,000. Labour, the cost card, $8 a unit. So 11,000 units, produced 88,000. The variable overheads, what were they on the cost card? $5 a unit, 55. And the fixed overheads from the cost card, $2, 11,000 units, 22, giving me a total cost of production of $297,000. But that's the cost of the 11,000 units we're producing. To get the cost of the 9,000 we're actually selling, we subtract the closing inventory, 2,000 units. And how much are we valuing them at? Well, the cost per unit from the cost card, $27, which gives me 54,000. And so the cost of the goods sold, the difference of 243. And so where are we? Sales revenue, 315. The cost of the goods sold, 243. Ends up leaving me with a gross profit of 72,000. Now, I know there are some sales costs to bring in. I'll deal with them separately. But gross profit 72, which is what I got before. I could have written it straight down, could I not? We sell 9,000 units. The profit per unit, we wrote down earlier, was $8.72. But in fact, the profit's not going to be 72, and why not? Look at that statement again. And I said earlier, you will not be asked to produce this full statement. I've done it so I can explain the problem. The problem is this. When I did that statement, and you may have noticed as we went through, We said, oh, materials 132, no problem. It's $12 a unit, multiplied by the number of units. Same with labour, same with variable. But fixed costs by definition don't change with the level of production. We budgeted there'd be 20,000 a month. And therefore this should be 20,000 a month, whether we produce more or whether we produce less. And yet what have we done? We've put in 22,000. We said, oh, it's $2 a unit, 11,000 units. Now, of course, you could just change and stick 20,000 instead and then work out the profit. But the point is, management, you've told them we're going to make $8 a unit. They're going to expect 72,000. And the management accountant's job is to tell them, well, why isn't the profit 72? And the reason it's not 72 is ending up with 72 assumes we will make $8 a unit. Assuming it's $8 a unit does assume that fixed overheads are $2 a unit, and you can see the problem. By using $8 a unit here, we've effectively overcharged the fixed overheads. And to get the correct profit, we do need to adjust. We adjust for what we call here the over-absorption of fixed overheads. And why over-absorption? We've absorbed, or we've charged 22,000. The correct figure for fixed overheads, produce more or produce less, is 20,000. We've overcharged, we've over-absorbed. And although the amount here is pretty obvious, we've charged 22, it should be 20, we've overcharged with 2. Because in the exam, you won't be doing the full statement. See how we get that? We compare the amount absorbed and the amount charged, the amount absorbed, is always the production, the actual production, of here 11,000 units times the absorption rate for fixed overheads, $2 a unit. Now, I know I'm repeating what I did before, but I say again, you won't be required to do the full statement. We can write the gross profit straight down, 9,000 units at $8, but we're going to have to correct it by this over-absorption. And so the amount absorbed, 22. What's the actual fixed overheads? Well, then, unless you tell it's different, we assume it's the budgeted 20,000. And so we've over-absorbed by 2,000. And so what's the correct profit going to be? Make sure you get this the right way round. We've charged 22 as an expense and arrived at a profit of 72. We should have charged 2,000 less. And if there's a lower expense, there's a higher profit. We'll add it on. And the correct gross profit is in fact 74,000. Now I know I keep repeating the same thing. I haven't quite finished this, but I will in a minute. I know I keep repeating the same thing. You won't be asked to do that full statement, but you could be given this and asked, what is the profit in January? Well, you don't want to waste time writing down everything I wrote down. You'll say, at $8 a unit, I'm thinking I'm going to get 72. But we'll then calculate, have we over or undercharged the fixed overheads? Here we've overcharged, over-absorbed. You'll adjust by the 2,000. The correct profit is 74. Now, the reason I've not finished is unlikely for the exam, but just to make a point, for something later. There are also selling costs, if you look at the question. Well, no problem there. The problem is arriving at that gross profit. But to get the final profit, we'll subtract the selling costs. And there are two. There's a variable cost, $1 per unit. Well, it'll be selling costs, it'll be per unit sold. So we sold 9,000 units. At $1 per unit is 9,000. In addition, there are fixed selling costs of 2,000, a total of 11. So the final profit is in fact 63,000. Now, selling costs are very unlikely in the exam because there's no problem there. We don't absorb the fixed selling costs. And so whatever the selling costs are, we simply subtract, and that's the end. All right, well, I hope that makes sense. Let's have a look at February. In February, remember, at the end of January, we had some closing inventory. We had 2,000 units. So in February, we start February with 2,000 units. And here we only produce another 9.5. And we sell 11.5. And again, it says a profit statement. But this time, although I will do a profit statement after, hopefully convince. Appreciate what I've said several times. They won't want the statement in the exam. They'll want to know what is the profit for February. Do a statement if you want, but why waste time? To get the profit for February, look back at our cost card. We budgeted our profit of $8 a unit. We're selling 11,500 units. At $8 a unit, you're expecting a profit of 92,000. However, costing it at $8 a unit does treat the fixed overheads as though they are whatever it was. I've forgotten, $2 a unit. We need to adjust for this over or under absorption. We'll check which it is in a moment. But look back to what I did before. We compare the amount absorbed, and the amount we'll have absorbed is always the actual production, which is 9,500 units, times the fixed overheads per unit, the absorption rate, which was $2 a unit. So when I absorbed 19, we compare that with the actual figure, which again, fixed overhead should be 20,000 a month, whether you produce more or less. And so this time, we've under-absorbed. We've only charged 19. We should have charged 20. We've undercharged by 1,000. And how's that going to affect the profit? Well, if we've only charged 19 and should have charged 20, we've undercharged. We need to charge an extra 1,000, which gives the gross profit as 91,000. Now, in any normal exam question, that would be the end of it. Again, they won't want a full statement, and usually no mention of selling costs. Here there are selling costs, but they're just a formality. The variable cost, it'll be based on the number of units sold, so 11,500 units at $1 a unit, 11,500. The fixed selling costs of 2,000 a month. So total 13,500, and therefore the final or the net profit 91,000 minus 13,500, 77,500. Finally, as I said, just to hopefully make 100% certain you've got it, although the correct gross profit is 91, let me, for the last time, do a full profit statement to make sure. Full profit statement for February. First of all, the sales revenue. We sold 11,500 units. The selling price is 35 a unit. Total 402,500. The cost of sales. Well, remember this time, since we finished January with 2,000 units in inventory, we start February with opening inventory, beginning of February, of 2,000 units. And the cost per unit from the cost card was $27. 54,000. We then add on the cost of the production. We produced another 9,500 units. And what's the cost of production? Materials, $12 a unit, so 11,000 at 9,500 at 12, 114. Labour, $8 a unit, so 9,500 at 8, 76. Variable overheads, $5 a unit. 9,500 at $5 is 47,500. Fixed overheads, $2 a unit, 19. So the cost of production, $256,500. And so the total cost of sales, the opening inventory plus the cost of those produced, is 310 at 500. And so what's the profit? Well, as things stand, 402, 500. Minus the cost 310, 500 is 92,000. But of course, the reason you don't require the full statement is yet again, I'd written that straight down earlier. 11 hours sold, $8 a unit, 92. But when you look at the statement, you can see why it's wrong. In arriving at that statement, we'd put fixed overheads in at 19. They should have been in at 20. So again, we'd under-absorbed by 1,000. And the correct figure is in fact 91. So think about that and learn the rule. Where did I write it? Here we are. The amount of the over or under absorption. You compare the amount absorbed, so the actual production times the absorption rate, with whatever the overheads should be. Here we are budgeting on 20, so they should be 20. The difference between the two is what you've over absorbed. Now, one last thing for this chapter. When we started it, I said for this question, because we were only producing one product, we could work out the absorption rate per unit. 20,000 overheads, 10,000 a month, $2. More commonly, as you saw again in the last chapter, or the chapter before, we work out an absorption rate per hour because we're making several products. Well, look at example 2 with me in this chapter. Y budgets on working 80,000 hours a month and having fixed overheads of 320,000. During April, the actual hours worked are 78,000 and the actual fixed overheads are 315,500. They should of course be 320, fixed overheads are fixed. But that doesn't mean they can't change. We could have estimated wrong. Costs could have gone up, costs could have gone down. Well, the actual overheads, they should be 315,500. Part A says, what's our absorption rate per hour? Well, we spent enough time on this 2 chapters ago. The absorption rate is based on what we budget. We've budgeted on overheads of 320,000. We're budgeting on working 80,000 hours. So the absorption rate is $4 per hour. Every hour worked, we'd be charging $4. The question, just like an exam question, it says, how much have we over-absorbed in April? Well, let's apply the rule I told you. The over-under absorption, you compare the amount absorbed or charged. And although we can't do a full profit statement here, I keep saying you wouldn't be asked for it, and we can't here, we haven't enough information. In our profit statement, if it's units, every unit produced will be charged at the absorption rate. If it's hours, every hour worked, so actual hours worked, 78,000. They'll have been charged at the absorption rate of $4. So if we were doing a profit statement, we'd have charged 312,000. How much should we have charged? We should have charged whatever the actual overheads turned out to be. If we'd been told nothing, you'd have assumed they were as budgeted, 320. For some reason, they were here a bit lower. The actual fixed overheads were 315,500. And so have we over or undercharged? Here we've undercharged. The difference of 3,500. And although that's the end of the question, what effect would that have on our profit? Would we have to increase or reduce our profit to get the correct figure? Well, since we've not charged enough, we've undercharged, we'd need to charge more, and we'd therefore subtract from the profit. So there we are. The important thing to get from this chapter, for the last time, is not those full profit statements. It's this. Be clear what we mean by over and under absorbing and why it occurs. And obviously learn the rule. Be able to calculate the amount of any over or under absorption. Now I'll leave that there. However, because there's always that bit of messing around, some people say, oh, why on earth do we bother? Why have fixed overheads at $2 a unit? We know fixed overheads are going to be 20,000 or whatever it is. And so there is an alternative way of costing, something called marginal costing. So what we've been doing here is absorption costing. In the next chapter, in the next set of lectures, I'll explain what we mean by marginal costing and what the effect of it is.